Okay, let's unpack this. You know how we love to take a stack of information, dig deep, and find those surprising nuggets that, truly inform you?
Hmm,
Today, we're doing a focused deep dive into a series of recent insights from Fund at Mental, specifically written by Gustavo A. Cano.
right.
We've got a collection of their recent posts that offer a fascinating, almost real-time snapshot of what's happening in the global economy and how these shifts might impact your financial reality.
And what's fascinating is how these seemingly distinct pieces, published just days apart, they really paint a very clear picture of underlying tensions and shifts when you look at them together.
Yeah.
Our mission today is, well, to go through each source,
Mhm.
piece by piece, extract the most important insights, and kind of connect those dots for you,
Right.
helping you understand not just what is happening, but why it truly matters in the bigger picture.
Okay, let's kick things off then. The first one in our stack, ratios and rationale. This article immediately throws a striking paradox right at you.
It really does. It points out that U.S. equity indices and S&P valuations are at all-time highs.
Okay.
And the Buffett indicator, that's the ratio of U.S. market cap to GDP also soaring, even after factoring in the Federal Reserve's balance sheet.
Right.
And this isn't just a U.S. thing. Global equities collectively amount to $135 trillion. That's 122% of global GDP.
Wow.
But here's the kicker, the real insight. Global debt. It stands at a staggering $324 trillion.
324 trillion.
Yeah, almost 3 times global GDP.
Right.
The article calls this a gigantic leverage in the system. Think of it like the global economy running on a credit card bill that's 3 times its annual income.
It's a powerful image.
While the asset side, what we own, looks great. The liabilities, what we owe, are just immense.
And the article brings up a truly historical concept here, the debt jubilee. Can you quickly explain what that was?
Yeah.
And, why it's relevant now?
Sure. Historically, in places like ancient Mesopotamia, Greece, Israel,
Mm-hmm.
a debt jubilee was basically a societal reset.
A reset.
Yeah, every 50 years or so, debts were canceled, slaves freed, land returned. Interestingly, these often coincided with new rulers coming to power, maybe because the previous guy ran up too much debt.
Huh.
So the article subtly asks, if there's no modern systematic reset mechanism like that today, and global debt keeps piling up like this,
Right.
at what point does the interest burden just become unbearable? Or do investors eventually have to sell assets just to cover debts?
So it makes you wonder, is this time truly different? Or are we heading towards some kind of involuntary reset?
Exactly. That's the underlying question.
So we've laid out this macro backdrop of, immense global leverage. But what does this mean for the everyday reality? For jobs, employment? Our next piece, participation rate, surprisingly ties into this. It shows how some of these larger economic shifts are impacting, the workforce itself.
Precisely. The article discusses the recent U.S. unemployment rate for June, 4.1%. Widely celebrated, right? Full
Okay,
employment.
that sounds good.
But, as the piece highlights, the devil is in the details of how unemployment is calculated.
How so?
Well, to be counted in the labor force, you need to be actively looking for a job between 16 and 64.
Okay.
This means full-time students not looking, incarcerated individuals, and crucially, those who've just given up trying to find a job for years, maybe lack qualifications, they're just not counted.
Ah, I see.
This is measured by the labor participation rate, and the article states it keeps falling. The really shocking detail here is that almost 40% of employable individuals are disincentivized from looking for a job.
40%, wow. And the article makes a crucial leap here, considering the impact of AI.
It does. It asks, what's the impact of AI going to be? The suggestion is, if workers find they just can't compete with AI for jobs,
They'll just stop looking.
they'll stop looking altogether. Exactly. This could lead to a scenario with a seemingly very low unemployment rate, maybe 2–3%, without the usual wage pressures.
Which sounds good on paper.
On the surface, yeah, like a Goldilocks environment, low unemployment, no inflation. But the reality would feel way different for those not participating. It warns us, be careful what you wish for, because you might just get it. A powerful warning, really. Challenged how we think about full employment now.
Definitely. While those market valuations and employment figures might seem abstract, they're intrinsically linked to issues like the dollar's strength and inflation.
Right.
Our next piece, dollar and inflation, highlights a significant disconnect in a key area of economic policy.
Yeah, this one points out that the Trump administration keeps talking about a strong dollar policy,
Right?
yet the trade-weighted U.S. dollar has actually depreciated 10% year to date.
10% down. Why?
Partly attributed to the growing debt and deficit, the stuff we just talked about, and also investors looking for maybe better valuations elsewhere, internationally. The White House, the article notes, wants lower interest rates, and a lower dollar would make American-made products more competitive globally. That ties into key campaign promises.
Makes sense politically.
But, as the source underscores, a weaker dollar has direct side effects for us, the consumers.
So what are those side effects, specifically for our wallets?
Well, a 10% depreciation, according to the article, can add 0.3% directly to the Consumer Price Index, the CPI, inflation.
Okay, 0.3%.
And that figure doesn't even include potential impacts from tariffs or the effect of the recently passed OBBB and bonds legislation, which adds more fiscal pressure.
Right.
The article projects that if the dollar were to depreciate another 10%, we'd be looking at maybe a 3% inflation rate.
And the Fed wouldn't like that.
Probably not something Jerome Powell, the Fed chair, would be willing to accept easily. This is identified as one of the keys for the second half of the year. Suggests a potential clash between political goals and monetary policy.
Interesting tension there. These discussions around the dollar and inflation naturally bring us to trade policy, and a particularly unique approach is highlighted in the piece No Love Letters.
Yeah, unique is one word for it. This article delves into President Trump's distinct communication style, specifically using actual physical letters to major U.S. trading partners.
Physical letters, really?
Yep. These letters basically state that starting August 1st, the U.S. intends to impose a 25% tariff to address what he believes has been an unfair trading relationship.
Okay.
The source details the strategy, offering the carrot to bring manufacturing back to the U.S. while holding the stick, proportionally increasing tariffs if countries retaliate.
Carrot and stick. And there's a specific mention of China in these letters, right?
Yes. The letters include a succinct reference to China regarding something called transshipping.
Transshipping? What's that?
That's when goods are shipped through an intermediary country, say from China to Vietnam, then to the U.S., maybe to hide the origin or avoid tariffs. The article points out that for items China diverts this way, the tariff rate will be a hefty 45%.
45%.
But the practical challenge, it notes, is actually controlling or tagging those items in foreign ports. How do you track that effectively?
Big question.
It also points out that while the U.S. is collecting tariffs at maybe a $300 billion annualized pace, this will likely be hard to maintain and probably cause trade to slow down.
Right. And the article ends with a thought-provoking quote.
It does, from Tom Friedman. It paraphrases him being asked if Trump was the president the U.S. deserved. His answer was something like, probably not, but it's the U.S. president that China deserves.
Quite a statement. Highlights a particular perspective on that whole trade strategy.
Definitely.
Okay, so from the specifics of trade, let's broaden our lens now. The long game, and it challenges some of the more optimistic economic views out there.
Yeah, this one opens with a Warren Buffett quote. Predictions tell you more about the person that makes them, rather than the predictions themselves.
Classic Buffett.
Indeed. It then starkly contrasts White House growth projections with those from independent bodies like the CBO, calling the White House's optimism maybe a dangerous understatement.
Why dangerous?
Well, the core issue presented is that the U.S. is piling up on debt. The Treasury is struggling to issue enough long-term debt without sending yields way up, and the dollar is sinking.
Sound familiar?
Yeah, connects back to the earlier
Yeah,
point.
exactly. And it draws a powerful parallel to another major economy.
Which one?
Japan. Suggests looking at Japan, 250% debt to GDP, around 3% inflation, only 0.6% growth as a potential indicator of the future for the U.S.
Oof, that's sobering.
It is. The article then lists factors that give hope for the U.S., like AI, tariffs, onshoring manufacturing, but it quickly qualifies them.
How so?
AI has no clear immediate path, faces tough competition with China. Tariffs collect some billions against a trillions problem. Onshoring will take years to play out.
So not quick fixes. Not at all. And the piece warns, if bond yields continue to rise or even just stay where they are, the commercial real estate market could collapse, adding a few more trillions to the problem.
And that gets blamed on?
Likely the Fed, it says. But it's really a lethal combination of high costs of debt and remote working. What's really insightful is that equity markets seem to be not discounting any of these scenarios.
Just ignoring it.
Kind of living day by day. It concludes that investors are just waiting for the straw that breaks the camel back, that critical tipping point.
Wow. Okay, moving to the very recent. Dawn of the petrodollar. This gives us insight into how the global reserve system itself might be shifting.
Right. This one cites the IMF's latest COFA report, its currency composition of official foreign exchange reserves.
Okay.
While major central banks primarily hold U.S. dollars, euros, yuan, the report shows a significant jump in Swiss franc reserves.
Swiss francs? Really?
Yeah, although it's still minuscule compared to the big guys, the jump is eye-popping. And what's truly telling, kind of counterintuitive, go on. The interest rate curve for the Swiss franc, the CHF, is negative up to 5 years.
Negative. They're paying to hold it.
Exactly. Central banks or large money pools are paying to hold Swiss francs when they could be earning interest holding euros or dollars.
Why would they do that?
Well, the source argues this is a clear signal the global reserve system is changing. More gold, more CHF, and less dollars and euros. It indicates a quiet but fundamental shift away from traditional reserve currencies.
That's fascinating. And the article ties this back to trade policy, asking if the U.S. approach is maybe myopic.
It does. It poses a hypothetical. If you're a country leader trading with the U.S., you get one of those letters about 25–40% tariffs.
Right.
You might strategically decide, okay, maybe I'll sell less to the U.S., more to other countries, and maybe accept payment in their currencies, not dollars.
So the tariffs could actually be pushing countries away from the dollar.
That's the potential consequence highlighted.
Yeah.
An unintended acceleration of a shift away from the dollar as the primary global reserve.
Okay, that brings us right up to date. Our most recent source, Upflow. This covers new tariffs and a powerful signal from the bond market.
Yeah, Upflow reports on the Trump administration imposing new 35% tariffs on selected Canadian goods.
Canada now, too.
Seems so. The article observes that what might have started as a negotiation tactic seems to be morphing into a collecting mechanism to pressure other countries.
And the administration thinks?
They believe foreign producers will just absorb these price increases entirely, not U.S. consumers. But the bond market is explicitly not buying it. In fact, the article says long-term bonds are screaming to the world that this path is unsustainable.
Screaming? What does that mean?
Unsustainable not just for the U.S., but for Europe, the U.K., Japan as well. High debt, high deficits globally.
So what's behind this screaming from the bond market? What are they really telling us?
Well, after years of near-zero interest rates, we're now in a regime where bond yields are rising.
Right.
This is attributed to a combination of higher inflation expectations and, again, those high levels of government debt and deficits. The article also notes ongoing armed conflicts don't help. Reminds us that since the Roman Empire, wars have been financed with debt.
Always comes back to debt.
Pretty much. And the critical point here, the yield curve is the backbone of all asset classes.
The backbone.
Yeah, because asset valuation, stocks, real estate, everything are derived by discounting future cash flows using government debt yields. When those yields go up,
valuations have to come down.
They must come down. It's math, not an opinion, as the article puts it.
And that's highly relevant when markets are at all-time highs.
Exactly. Highs that were inflated by years of zero interest rates.
Yeah.
So the pressing question the article leaves us with, and maybe the most important one from this whole deep dive is, when and how would that happen?
When does that repricing happen?
Yeah. When and how does everything adjust to this new reality of higher borrowing costs?
Wow, okay. That was a lot to take in, but what an incredible journey through these recent insights from Gustavo Cano and Fund at Mental.
It really connects the dots.
You can really feel the interconnectedness, can't you? Global currencies, trade policies, employment figures, market valuations. It's clear that while some numbers look great on the surface, there's a lot more bubbling underneath that, well, truly deserves a deep dive like this.
Absolutely.
Yeah.
And if we connect this to the bigger picture, all these individual threads, the rising global debt, the shifts in currency reserves, the impact of tariffs, they all point towards a period of significant reevaluation.
Yeah.
And potential volatility in the global economy.
Yeah.
Which really raises an important question for you, the listener, to consider. As these underlying pressures build, and the bond market, as the article says, continues to scream, how might all this ultimately reshape not just national economies, but our daily financial realities, our investment strategies in the years to come?
Yeah.
Something to think about.